Hi, good afternoon, everyone. It's the last session of the day, and for most of you know me, I don't really like to keep people away from the drinks. So we're trying to make this short and hopefully sweet. So I'm Zhou from Nuveen Real Estate. For people who don't know us, we are a global investment manager owned by a teachers' pension fund in the US. And my remit within the firm is looking for data center investments globally, including North America, Europe, and here in APAC. And with that, I'll pass on to my panelists to give a brief intro.
Hi everyone. Apologies if I sound a bit like Darth Vader. I just lost my voice yesterday, still recovering. My name is Nirad Deshpande. I'm a part of the investments team at Macquarie Asset Management. So we invest, the world's largest global infrastructure asset manager, invest in all different asset classes across the infrastructure value chain. I look specifically at Southeast Asian and Indian markets for infrastructure investments, but particularly also focus on digital infrastructure.
Well done for getting through with a broken voice, and good stamina for everybody who's still here. I don't think we'll be that long today. My name's Charlie Wilson. I'm a partner at Sidley, which is a leading international firm based in the States. I lead the M&A and private equity team across Asia, and through that we've focused an awful lot on digital infrastructure work, which is, I guess, why I'm here today.
Hi, Paul Carpenter. Hello, 1, 2, 3. People tell me that. I don't think this. Oh, there we go. Paul Carpenter, Hardiman Telecommunications. We are a boutique tech commercial advisory firm. We work in the digital infrastructure space, do a lot of the due diligence for a lot of the digital infrastructure deals that have been done in this region, in Africa and Europe. We've been in operation for about 26 years or so, and I'm the partner here in Asia.
Great, thank you. So I've been told today there's a lot of talk about data centers, and getting back to the topic today, digital infrastructure. Let's focus a little bit more on the long DC stuff in this big playground. To start with, let's look at it globally, comparing APAC with the rest of the regions. To me, because my sole focus is in data centers, so I do see this trend generally is start with North America, slowly gets to APAC, gets to Europe, and then filtered down to APAC, such as AI demand, the cloud demand back in the days. So I'd like to pose a question to everybody here. What do you see outside of data centers in other sectors within digital infra, the trend, and how we compare APAC region with the two other big ones? So I'll start with you, Paul, because you did have a lot of ideas.
Sure. We see those transactions across fiber, across towers, across subsea, in data centers. We see the whole 5G mobile dynamic going down. And for me, Asia is a little bit different to all the other regions because you have a real spread of developed networks through to developing networks, or developing markets, sorry. So you see the whole technology life cycle across all of the assets. You see that in this Asia region and by that I mean Japan through to Australia, over to India, up to China, and everything in between. You see all of the stages. So I think in certain sectors, the development of infrastructure providers for that particular asset is a little bit behind. In some areas, even like Indonesia and Malaysia, I would say they're almost ahead in some areas compared to Europe, right? And certainly Africa. So you have a massive spread.
How about you, Charlie? What do you think?
Yeah, I mean, obviously this today has been very focused on data centers, understandably, but that's kind of part of the diet that we see on the transactional side. You get a little bit of the cables and subsea cables and satellites, but those kind of deals don't happen that often. So your main diet as a transactional lawyer here will be a spread of data centers, fiber, and telecom towers. And when you look at it, just as people have said before, Asia really is a patchwork, and you get, for example, the telecom towers business in Indonesia is completely different to where it is in the Philippines, completely different to where it is in India, completely different to where it is in Thailand. So you get massive variability in sort of different levels of maturity, and that gets you doing different types of deals. And you can see consolidation has happened in some markets, it's nowhere in other markets. So yeah, for us it's a much more of a blend. And I was thinking before we came on, if I had to sort of set out of 100% of my digital infrastructure work this year, the whole team, the biggest percentage would be fiber, then data centers, then towers. But, you know, pretty evenly split.
But totally different 2 years ago.
Completely, yeah. I mean, it's very...
Okay, Nirad, as a global asset manager, if you are the global portfolio manager trying to allocate your capital amongst those fiber, tower, and data center, and also to allocate amongst APAC, Europe, and the US, what's your thinking behind?
Yeah, so I think fortunately for us, it's different pools of capital that address the three different regions. So we do learn a lot in the Asia Pacific region from, and more specifically if I narrow it down to Southeast Asia and India, we learn a lot from the trends that we see in the US, in Europe, and even in places like Australia. So I do believe that some of the adoption is maybe a bit behind, whether it's an independent tower co, whether it's a neutral fiber co getting set up in this part of the world. There are probably more mature platforms and organizations in the US and in Europe which have done that already. And thankfully we are able to adopt some of the learnings, modify them as needed. I think the biggest difference that we see in Southeast Asia versus the rest of the market is just the sheer numbers here in terms of growth. I think it's mostly a secular trend. Obviously, each of the geographies are different, but mostly a secular trend where there's a large and growing population, GDP is growing, most of these countries would end up being top X economies in the next several decades or so. So the amount of greenfield growth that we see here is a bit unprecedented to what we would see in other markets. And I think from our perspective, when we think about allocating capital, a lot of it comes down to how we're able to price some of these growths in and price the risks around the greenfield growths as well. So that probably is what drives our thinking in APAC, right? It's still a region that our LPs want to invest quite heavily in because of the diversification benefit they get, but also because of the growth story that they're able to participate in.
Thank you. That's actually leading to my next question. So in which case do you see in APAC, it's more organic growth story or it can coupled with M&A? And what do you see the M&A opportunities across APAC in digital infra space?
Yeah, I think the mix of both as well. I wouldn't say there's a focus on one particular type of opportunity. For the last few years, what we've been seeing has been a very clear trend where the telcos have wanted to carve out the passive infra assets out of their balance sheets. So we've had a lot of these disposals that a lot of us as well as our peers have been quite actively looking at acquiring. I think where we are today, it's been a market which is a bit fragmented. If you look at Philippines, if you look at a lot of the other markets, Indonesian towers are probably different, but the general trend is it's a market which has a lot of pools of capital chasing limited opportunities, and it's a fragmented market. Where we see an opportunity going forward is probably going to be in consolidation in some of these sectors. Greenfield, yes, I think there will be an element of greenfield growth, and so having a large scaled up platform is probably beneficial, where you're able to not only aggregate some of the fragmented opportunities out there in the market, but also get into greenfield solutions across the value chain of digital infrastructure for the end customers.
Thank you. Charlie, from legal perspective, we talked earlier, you also see the combination of M&A and organic growth. Could you share with us some of the cases you are involved in, the opportunities and risk associated to that?
Sure. I'd say over the last year there's just been less auction processes, really. I think we've still got that telco desire to offload assets from the balance sheet. But I think their financial advisors and their BD teams would have said we're not going to get optimal valuation because of the interest rates. So I think a lot of them have held. So the kind of deals that I've done this year have been a lot more development JVs across Asia, sort of maybe contributing land, but very early stage, sort of just setting it up with a view that's going to be capitalized. Also, small acquisitions, strategic acquisitions, where the investor goes in really buying the license, maybe some sort of core skeleton assets, and has got the management team and the money to roll out aggressive growth because they're using their equity. They're not at a developmental level, they're not having to worry about the interest rates and the debt. So that's how we've seen it this year, much more organic growth, really, through a combination of joint ventures and acquisitions and rollouts rather than the big auction processes.
Yeah, I mean, I'd add to that, a lot of the stuff that we're doing at the moment are what-if analyses. So people are asking us, all right, should we keep them, should we dispose them? I was just up on a call, I had to duck away, and that was the exact question for a particular project we're working on at the moment. Mm-hmm. It was, what happens if we change our mind and do it this way instead of that way? Because there is a lot of questions at the moment from the operators, from asset owners who are looking to dispose or thinking of disposing, of how they do it and should they do it. I think everybody realizes it's a general trend in this region. From that perspective, they have learned from other markets, but they're also then thinking, what do we do as a result, right? Yeah, so.
But Paul, from the organic growth perspective, and I know you've done a lot of work in the due diligence, whether it's commercial or technical, if investors who has never been in the region coming in with the capital, is there any experience sharing or opportunity or risk you would like to highlight to those investors?
You asked me to do a set now.
I gave you 2 minutes to answer that question.
I think that the issue with this, and Charlie sort of highlighted it, and Nirad actually, is every country is different. They're all in different stages with respect to each asset class. And you know, no one network or one asset is the same. And you can only really look at that asset in the context of its market at that time and at that stage and decide what you're going to do. And again, you know, work that we did 2 years ago with certain advice at that time is now very different in the current conditions and with the current changing competitive environment. Like the Philippines being a great point, case in point, because of the competition in the tower market that has evolved. It's totally changed how everyone is now thinking about that market and what they're planning to do. And so, depending on whether you are an experienced operator or you're new capital, because the other thing that's happened with us in the last 2 years is that we've had such, you know, it used to be usual suspects coming and knocking on the door and asking for advice. Now everybody is coming and knocking on the door and saying, oh, digital infrastructure or renewable energy, we need to be in that. I think someone mentioned it on the last panel. They've been in it 5 years, so now suddenly they're an expert, right? But there's people that have been in it for a year or 2 years, and they're coming into this region because they've heard about the activity in the Philippines and they need to be a part of it, right? Without really understanding what the issues are. So I think the key issue is that there's a lot of very different markets in this region, from the most developed to the least developed. And you have to look at each individual asset and opportunity in the context in which it exists. I think that is the most important issue.
Thank you. Again, that leads to my next question. So in which case, given so much challenges across the region, because each country can, with its own market, own regulation, own capital source in a way. So for international investors who wants to come into this region, is joint venture with the local capital the only way or the best way to tap in the market? If so, what are the risk challenges that you've seen across all your field? Maybe I'll start with you, Nirad.
I think the way we tend to approach these markets is just go deep in each of the markets. So build a local presence, understand the issues and the key risks of operating in each of the markets. I don't think there is a one formula fits all in terms of whether it's just go with a local partner and as a JV or go 100% control. We've done all types of investments across geographies, and this is not just digital infrastructure but across sectors, where we've gone all the way from 100% sole control all the way to a minority investment and everything in between, including structured products, right? So I think all of the types of investments are probably catered depending on the situation. But having said that, in our experience, what it all comes down to is probably the management team. And that could be a partner, that could be just a professional independent management team running the platform. But it all really comes down to that. And I think that's probably the area where we spend most time diligencing as well. If it's the right management team, it's the right business and a good business, which is probably just temporarily starved of capital, then that's the opportunity that we like to get into. The structure itself per se on control, non-control, partnership GVs, that evolves depending on the objectives of both sets of team. That's sort of been our experience, and there have been hits and misses across the board in all constructs.
Yeah, I'd add to that. Like, I mean, if I look at all the DDs that I've done, they mostly fall down on management. People are not confident in the management. And if you take digital infrastructure, towers are fairly easy, fiber's a bit more complicated, and data centers are even more complicated. And if you haven't got the right people managing those assets, you're going to fail. And the likelihood of you being able to succeed increases, I feel, the more of the local content you have in that management team because of the local conditions and what you're managing. So it is absolutely fundamental. I'm not going to talk to capital structures. I don't get involved in that. It's beyond my pay grade, right? But in terms of an operational, I mean, I come from a background of building mobile networks and operating mobile networks. So, you know, to me, it's fundamental, and it's the biggest issue that you discuss during a DD over dinner with your client after you've had the meeting with everybody, and you say, so what do you think of the guys? What do you think of the team, right? That's the main question that gets asked.
That's an interesting point, because before Charlie, I'd like you to share the capital joint venture side. Just on the management, people used to tell me, human being is not a tree, you can move. So we have witnessed over the past few years, people moving across different platforms, right? So when you evaluate particular platform or management team at that point of time, it could come across very differently down the road in 2-3 years' time. So I'm going to give that question to you again. How do you evaluate that risk and how you mitigate that risk? Whether you prolong the lockup period for certain individuals, or whether any other way that you can keep the management incentivized and motivated to deliver the product you invested in?
Yeah, I think it's not easy, but it's making sure that you're aligned on day one, and that usually happens via a very clearly defined LTIP, a long-term incentive plan, which would effectively be a pretty material payout linked to the IRRs that we would make at our exit. And I think that, in our minds, is a very clear and an objective way to align incentives and objectives with the management team. But then there's obviously a lot of softer aspects when it comes to diligence around the track record of the management team that we would like to understand. Has the team been together for long? What have they delivered? Do reference checks on them from the teams that they've worked with. So you do all of that, but then objectively it comes down to, can you set up the right exit linked or long-term linked incentive program to align the management with your objectives, which is a high IRR at exit.
Thank you. Sorry, we moved away from that main question, which was really a joint venture partner with a local capital.
Paul always steals one.
But I always want to make sure you have your time to shine. And Charlie, I know you've done a lot of cases in that regard. I would love to hear your view and what you've seen, the risk and the returns in that sort of joint venture partnership.
Yeah, I mean, it's echoing a lot of what the panelists have already said. Very dependent on what type of company you are. If you're a big strategic, or if you're a private equity controlled platform, then you're looking at the countries that you're going into. So if they're mature countries, if you're looking at, say, Japan, you're feeling pretty comfortable about going in on 100% control, unless there's reasons why you feel you need to have a local partner. If you're a new entrant or a private equity-backed platform, often, or if there's foreign ownership restrictions, then you're looking at shareholding arrangements. And that's when it gets a lot more complicated. Just a straight acquisition agreement's pretty straightforward. It's the shareholders agreement where you've got to anticipate the whole life cycle. If you're a strategic, there's a lot of similarities whether you're a private equity fund or a strategic, but there's also the big difference is the exit. Because the private equity fund has to have the exit. If it's a core business for both the local partner and the strategic, it could last for 50 years as a joint venture. So I think it really depends on a lot of emerging markets. People will go in via joint ventures, and then so we could talk about it for a long time, but it's really about getting the right partner, doing really deep dive DD on that partner, particularly how they've behaved in other joint ventures. You've got to have somebody who's thinking the same way as you, take a lot of time on reaching that agreement, and an awful lot of time on your business plan and your budget to make sure you're both completely aligned, and that they've got deep enough pockets to match your plans, and also plan Bs and Cs where things aren't going to work out quite so well. So necessary sometimes it works out very well, but it adds a definite level of complication if you've got shareholders in, and also if you're going to be planning for an exit via a private equity fund.
What we've seen a lot of times, given the digital infra in general, this sector is so hard. So as a capital provider, investor coming to the joint venture, in some cases we've seen, the local partner looking for majority of the capital, but they want to retain majority of the governance. How do you see in this region, I want to use the right word, massage was the right word, through the negotiation, have you come across this kind of situation that they get to the middle ground, or at the end of the day, how they get solved that type of differences?
If they've got a
so it's more of a joint venture. Let's just say 30-70%. Capital provider provides 70% capital, but the 30% who are let's say management team delivering their product, they are looking for majority of the governance, dictating the exit, dictating their management. And that is something I think as a pure financial investor, the challenge we often see in this sector.
Yeah, well, I mean, if the private equity fund's 30%, it's probably rare to get that situation. I mean, normally they'd be going in at control, and they're driving it to the exit. And then just within normal situations, you just get that whole range. You've got an 80-20 spread down to 50-50, and there's sort of a graph of different levels of control that you'll have at different times. I wouldn't normally see a 30% controlling things, even if they've got the skill sets. The money's going to play a big role in that decision making.
How about you, Nirad? Have you seen those cases? I know you guys normally just go in to buy 100% company.
No, I think you do come across asks like that, right? I think it's not rare. It's not easy in that situation to agree to that. If you're, as a private equity, and our approach has been typically to be in control of our destiny. So if you're putting in majority of the capital, to relinquish control becomes hard, but if you can define a set of governance and a set of rules around which the management team can function, you can still give them enough independence for them to run the business on a regular course, and then key issues get escalated to you. So I think there is a way to structure it, but from our perspective, what's very important is if things go bad, we are able to step in and correct it, and we are in control of our exit destiny. So as long as we can solve for the key risks or the key issues up front, there is a way to work around it, but it's obviously not the preferred approach where you would usually just want governance to be pro rata to the capital that you put into the business.
That sounds more like getting a sort of a management team or a minority, and it would all be in the business plan and the budget that you plan and set. And say, okay, you guys go off and do that, we'll check in, we'll talk. If anything changes, we will come in and,
It was like that in the Philippines. There was lots of local partners who were vying for, let's call it a sugar daddy, right? And those conversations fell apart pretty quickly. And everybody sort of eventually got into line, right, as to where they should be. The only exception I would say to that is some of the Japanese trading partners. They tend to look for very experienced operators and then just put a bit of capital in, right? So it totally depends on how they do it, right, what they want to do. Cocktails.
I'm going to still try to, since we talk about this topic, just allow me for another 2 minutes. In terms of exit, we mentioned exit a couple of times, and I think the digital infra in general, from the private investor perspective, is still relatively new. So we haven't seen a major exit yet. I'm trying to move away from data center, but I have to take data center for example, right? Nowadays, each one single data center, if you get into the MEP, it can easily go up to 400 or 500 million as a cost to build and sell it. However you want to make the IRR work. Do you see this sufficient liquidity gets built up in this market in APAC? And how do you see those sizable investment in digital infra? What is the exit channel for those investments?
Yeah, I would look to the more mature markets, in this case, markets like US and Europe, where there are precedents of massive trades happening. In the Southeast Asian market, there's a very clear track record of trading on tower cos. Fiber probably getting established, but the kind of transaction volumes on tower cos are catching up to where we expect some of the data center trades would happen in the future, right, which would probably be in, I don't know, tens of billions for some platforms. I think it's untested, so we do worry about that exit, and if there is going to be a pool of capital that could solve for that volume or that quantum of single exit. But from our perspective, when we look around in the market, when we're looking for opportunities, there's enough dry powder that's available in the market today across our LPs, across all the other GPs, which have raised similar capital and going after similar opportunities. But yeah, I think over time we would want to see that keep getting bigger and follow the trends that we've seen in US and Europe. Capital markets, again, potential exit here, but something that needs to be tested this part of the world as well. So it's unproven. I think right now, a lot of us are thinking about 4 to 5 years scale of the platform, and then we've probably got to solve a problem of tens of billions of dollars at some point. But the hope is that the capital will come.
Well, I'm putting my pension into towers and fibre. My wife is a Canadian teacher, so maybe we should continue the conversation afterwards, because I think a lot of people are hoping. I think a lot of people are hoping that the pension funds are going to be coming to the rescue of everybody's investment at some point, right?
I mean, I would have thought there's a fair degree of confidence that you'll get the exits, and everybody wants to deploy capital in this part of the world. There's a lot of dry powder, and it's not digital infrastructure, but if you go back a few years, there was a big platform called Equus that was in renewables, and the interest that elicited was massive because it was very big, scalable, ticked a lot of boxes, and then when you bring the good assets to the market in the future, I'm pretty sure you're going to get a lot of interest. Hope so.
Hope next year, this time, we'll be able to demonstrate some of those being a major exit. So with that note, we're open to the audience. Anyone wants to ask a question before you get to the drinks?
That's it.
Where are the drinks?
Sounds good. Thank you. Thanks, everyone. Thanks for your
Thank you, Jing, and thank you, panel as well.